So gold's ripped through $4,600 an ounce as geopolitical shocks and Federal Reserve intrigue, as well as military flashpoints, collide with a market already rethinking risk. Defense stocks are soaring, oil's asleep, and safe haven psychology has a new playbook. Well, to make sense of all of this, we're joined by Tom Winmill of the Midas Discovery Fund. Tom, thanks very much indeed for talking to us.
Devin, it's an absolute pleasure to be here. Thank you for having me.
Well, look, how bizarre is this at the moment? I mean, gold's at record highs, defense stocks are acting like bonds, and oil missed its cue. How do you read this market's reaction function right now?
I'd say these symptoms come and go. These short-term geopolitical factors come and go. What's behind it, in our opinion, is the likelihood that these factors, the U.S. militarization, the potential for $1.5 trillion defense budget, the ongoing expenses of this kind of neoconservative potential occupation of Venezuela, Iran, you name it, even the blue cities in the United States, it's all going to contribute to further fiscal imbalances at the U.S. government level and continuation of staggering, almost unimaginable public obligations of the United States government. So there's really no way back. I think the central banks of other countries are saying dollars are becoming increasingly risky. Let's go into gold.
I want to touch on some of those points. I mean, we had Iran, Venezuela flare-ups, a captured head of state, now a Fed chair under investigation. I'm wondering how much of gold's surge is geopolitics and how much is policy uncertainty?
Well, the geopolitical risks that the United States are taking on is a part of the policy, and it's part of a government hegemony that is also kind of heedless of the economic risks that it's taking by pursuing these policies. If the United States government decided to pull way back, cut the budget, start reducing its fiscal expenditures, it'd be all kind of the same piece, and I think gold would subside, the dollar would get stronger. But that's not happening. And I think what people are seeing around the world is the dollar's becoming more risky. It's likely to go down in value because we're going to need a lot more dollars to cover all of these international escapades.
So, Tom, investors seem convinced the leadership shakeup of the Federal Reserve could accelerate rate cuts, right? We've seen that sentiment before. If that narrative sticks, how should gold investors handicap the Jerome Powell succession risk?
That's interesting, Devin. I know there's a lot of belief that the Federal Reserve independence is important. It really, in my opinion, it isn't. It's really a bureaucratic struggle going on. It's kind of a little bit of inside baseball down in the Washington Beltway. I think the interest rates are going to have to be controlled because the interest expense for the United States government is becoming so large. It's approaching $1 trillion. The government really can't afford to have rates go higher, at least on the short end. And I think that's what the struggle is about. But one way or another, the United States government is going to have to print more money. It's going to have to do something, whether it's on the interest rate side or the printing press side. I don't think it makes much difference, in my opinion.
Listen, this oil price is a fascinating one, right? I mean, you've got a muted oil price. With Venezuela and Iran in the mix, why isn't crude trading a geopolitical premium? I mean, is U.S. shale credibility that strong, I would ask, or is the market mispricing energy risk? What's your take on that one?
Well, I'd say the Venezuela impact on energy markets is years and years in the future. It's going to take billions of dollars to recover those industries. It's gone from almost 3.5 million barrels per day to less than 900,000 barrels per day. The United States is not using a regime change approach in Venezuela. And what that means is that the same laws that have been in effect in Venezuela are still there. And that includes free carry to the government. It includes internal financing requirements, exchange controls, uncertain legal rights, unenforceable contracts, all kinds of problems. I think the first thing that's got to happen before the Venezuela oil deposits are unlocked for world sale is going to have to be a demonstration of property rights. These $12 billion Conoco claims, $20 billion Exxon claims against Venezuela, if they're not sorted out properly, I don't see why any company would risk putting more assets into Venezuela. And the same truth for the gold mining area, except whereas Venezuela deposits of oil can be accessed offshore relatively safely, in the Orinco district in Venezuela, there are also artisanal groups and industrial groups tied to organized crime that are heavily armed, that have the dibs on the best deposits in Venezuela. I don't see Venezuelan gold coming onto the market either anytime soon.
Now, defense equities have suddenly become a pseudo safe haven, right? I mean, I'm thinking, is that a knee-jerk trade, or are you seeing a structural, let's call it rearmament thesis that lasts maybe beyond this news cycle?
Well, I'd say if you look back over the last 3,000 years of human history, there's been a lot of violence. I've seen people say, well, Western democracies have thrived because they organize violence better. I think there's always going to be a certain amount of defense spending, but the United States is so far ahead of the rest of the world in defense spending. I think that is going to kind of provide a natural ceiling. So I don't think it's going to grow to the sky. There's only so many multiples of the combined defense spending of the rest of the world that the United States needs to bother with at this point.
Tom, you look at 2025. I mean, you had the banks, you had commentators, and you had all the experts throwing what they think gold will reach and what cap it will reach all over the place. HSBC floating 5,000 for gold in the first half of 2026. What has to go right or even wrong for that call to make sense in your world?
I would simply say if the interest rates in the United States are permitted to go down, and that will bring the dollar down naturally, and that is going to be a huge underpinning for diversification out of the dollar. And it's also going to, of course, increase the value of growth equities. So gold will become more valuable because the worthwhileness of financial assets will go down. So I'd say look for lower rates, look for a lower dollar, and I could see potentially $5,000 gold within a few years, no problem.
Now, finally, I mean, it's been a repeated question to many of the experts for such a long time over the past few months. For allocators watching this, I mean, do you treat gold and miners as a tactical trade on fear, or as part of a broader shift towards hard assets in perhaps a more fragmented, sanctions-heavy global system? How do you approach it?
Well, gold is just a wonderful hard asset because unlike real estate, it's not subject to property taxes in most jurisdictions. Midas Fund, the Midas Discovery that I manage, is up over 45% per year on the average in the last 3 years. I think gold has a wonderful future ahead of it. It's a great hard asset. It's a great diversifier, and it has provided a lot of performance if you go through the equities of well-managed companies. That'd be the way I would think allocators would like to approach it.
Well, Tom Winmill, thanks very much indeed for those insights. It's been a pleasure chatting to you.
It has been a pleasure indeed. I look forward to our next talk.